On April 20, 2023, a $3 billion Starship rocket exploded in a massive fireball over the Gulf of Mexico, and the SpaceX control room erupted into cheers. Had SpaceX been a public company, that single explosion would have wiped out $20 billion in market value and triggered a wave of shareholder lawsuits before the debris even hit the water. A private empire blowing up billions for science. A legal trap waiting on Wall Street. The secret plan to trick public investors. By late 2023, SpaceX was no longer just a gutsy startup. It was a $180 billion monopoly launching nearly 100 times in a single year. It was carrying 80% of all Earth's payload to orbit, leaving NASA, the European Space Agency, and Roscosmos scrambling in the dust. Yet, despite endless pressure from hedge funds and retail traders demanding an initial public offering, Musk refuses to ring the opening bell. Why is the most dominant aerospace empire in human history structurally terrified of the stock market? To solve this mystery, you have to follow the money back to a dusty island in the middle of the Pacific Ocean in 2008. On August 3, 2008, Falcon 1 Flight 3 lifted off from Omelek Island carrying active military payloads. 2 minutes into flight, stage separation failed. Residual engine thrust slammed the first stage into the second stage, destroying the rocket. SpaceX had zero remaining money in its bank accounts, and Tesla was concurrently bleeding $2 million every single week. Any traditional public board of directors would have immediately filed for Chapter 11 bankruptcy liquidations. Instead, Musk made his ultimate point of no return. He scraped together his last $30 million from selling PayPal to personally finance a fourth rocket. He proved right then that he would gladly burn every dollar to his name, rather than answer to a cautious investment committee. On September 28, 2008, Falcon 1 Flight 4 reached orbit, saving the Enterprise with only days left before payroll bounced. If SpaceX is printing billions in revenue today, why is Elon Musk so desperate to keep retail investors out? What Wall Street failed to realize was that SpaceX was never designed to be a business. It was structured as a multi-generational religion, posing as an aerospace contractor. Between 2010 and 2020, SpaceX pioneered reusable rocketry with the Falcon 9, driving launch costs down by over 70%. In December 2015, when Falcon 9 landed upright at Cape Canaveral, commercial competitors were caught completely unprepared. United Launch Alliance and Arianespace were charging $150 million to $220 million per expendable rocket launch. SpaceX came in at $62 million per launch, undercutting the entire global aerospace market in one clean sweep. By late 2023, SpaceX was no longer just a company, it was a total aerospace monopoly. Private tender offers placed the valuation at $180 billion, placing SpaceX ahead of Boeing, Lockheed Martin, and Raytheon combined. If you want to understand how this privately funded titan works, built and broken, takes one of these financial models apart every week. Private venture capital firms like Founders Fund, Sequoia Capital, and Fidelity poured billions into SpaceX funding rounds. They accepted one explicit rule: Elon Musk retains absolute voting control through supervoting B-class shares. In private markets, accredited investors willingly sign away governance rights in exchange for explosive equity gains. They knew Musk's primary mandate was not capital return, it was building a self-sustaining city on Mars. So long as SpaceX stayed private, Musk could incinerate $5 billion developing Starship without asking a single analyst for permission. But this unprecedented monopoly, is built on a financial philosophy that Wall Street considers absolutely illegal. To understand why, you have to look at what happened to Tesla the second it went public on June 29, 2010. Tesla raised $226 million during its initial public offering, but Musk instantly found himself trapped in quarterly earnings paralysis. Hedge funds took out billions in short positions, betting against Tesla's survival during the Model 3 production ramp in 2018. Every missed delivery goal produced aggressive television takedowns and brutal stock drops. On August 7, 2018, pushed to total physical breakdown, Musk tweeted that he had funding secured to take Tesla private at $420 per share. The Securities and Exchange Commission charged him with securities fraud, forcing him to pay $20 million in fines and step down as Tesla's chairman. That brutal public market war left Musk permanently scarred. He realized that public equity markets are not designed to fund long-term engineering vision. They are ruthlessly designed to demand 90-day profitability. Under United States corporate law, established by legal precedents like Dodge v. Ford Motor Co., corporate officers owe a strict fiduciary duty to maximize shareholder wealth. What happens when a CEO's personal mission legally violates his duty to his own shareholders? Imagine SpaceX as a public stock on the New York Stock Exchange. In Q1, SpaceX earns $2 billion in operating profit from Starlink broadband subscriptions. Wall Street analysts on earnings calls would expect that $2 billion to go towards share buybacks, dividend distributions, or debt reduction. Instead, Elon Musk transfers that $2 billion directly to Starbase in Boca Chica, Texas, to build a fleet of non-reusable test rockets to blow up over the ocean. Institutional shareholders like BlackRock or Vanguard would file immediate derivative lawsuits in Delaware Chancery Court. They would allege waste of corporate assets, breach of fiduciary duty, and illegal self-dealing. And under established legal standards, the court would force SpaceX to halt Starship spending or face personal judgments against the board. This legal trap isn't just felt in executive boardrooms, it directly crushes the actual humans building the rockets.
SpaceX employees are compensated with equity grants subject to strict private company liquidity constraints.
Engineers working 80-hour weeks become paper millionaires on SpaceX's $180 billion tender valuation. Yet they cannot liquidate their shares on an open exchange whenever they want. They are trapped in controlled private secondary sales. If a technician sells shares to an unauthorized party, SpaceX enforces strict rights of first refusal, clawing back equity instantly. These golden handcuffs keep key talent locked into the mission, preventing a wave of rich staff from quitting. Going public would create instant liquidity, making hundreds of senior engineers instant millionaires who could retire tomorrow. It would drain the specialized brainpower required to land on Mars. To survive an IPO, SpaceX wouldn't just have to change its business model, it would have to kill its only reason for existing. Remember that central question. Why is the world's greatest rocket company terrified of public markets? We are about to expose the secret financial mechanism Elon Musk built to trick Wall Street entirely. In 2015, Musk announced a project that seemed like an expensive side venture, Starlink. The goal was to launch tens of thousands of low-Earth orbit satellites to beam high-speed internet to remote regions globally. Telecom giants laughed. Previous attempts like Iridium ended in devastating Chapter 11 bankruptcies in the late 1990s. Building a low-Earth orbit constellation requires absurd capital investment upfront before earning a single dollar. Between 2019 and 2023, SpaceX deployed over 5,000 operational satellites, using its own low-cost Falcon 9 launches. Because SpaceX owned the launch vehicle, its cost to deploy a Starlink satellite was 80% lower than any external satellite company. By late 2023, Starlink announced it had achieved cash flow positivity, generating over $9 billion in annual revenue from 2 million active subscribers. This is where Musk's genius financial trap comes into full focus. Wall Street wants SpaceX equity because they see Starlink as an endless cash printer. Musk's master plan is to spin off Starlink as a standalone public company through a targeted IPO. Public investors will line up to buy Starlink stock for its recurring cash flow. Meanwhile, the newly public Starlink entity will enter into a multi-decade, exclusive commercial contract paying SpaceX for launch services. Wall Street gets the predictable utility business it craves, and SpaceX retains 100% private control, siphoning public market cash into Starship without ever opening its own books to SEC scrutiny. If you want to track how these hidden corporate structures work in real time, hit subscribe below. Built and Broken exposes one every single week. This financial firewall protects the master goal, building Starship into a fully reusable interplanetary cargo system. Starship stands 397 feet tall, powered by 33 Raptor engines, generating 16.7 million pounds of thrust. It is designed to lift 150 metric tons to low Earth orbit in a fully reusable configuration. No commercial customer on Earth currently requires 150 tons of payload per launch. Starship is completely economically illogical for commercial satellite delivery. It only makes financial sense if your explicit objective is colonizing another planet. A public CFO would look at Starship's balance sheet and immediately cancel the program. Because under public accounting principles, spending $5 billion to build a city on Mars yields a net present value of absolute zero. No Wall Street analyst models cash flows across 50-year time horizons. By remaining private, SpaceX operates outside standard quarterly financial mechanics. It can absorb explosive test failures as valuable engineering data rather than catastrophic stock drops. When Starship Flight 1 detonated after 4 minutes, the engineering team gathered telemetry on stage separation and engine dynamics. 7 months later, Starship Flight 2 staged successfully using hot staging separation. That rapid iterative development speed is only possible when you don't have to explain quarterly losses to retail investors. This brings us to the ultimate realization about SpaceX's corporate existence. The moment SpaceX goes public, its mission shifts permanently from space exploration to dividend optimization. Active hedge funds would demand cutting high-risk Mars R&D to maximize earnings per share. SpaceX would quickly transform into Boeing, a risk-averse defense contractor focused on stock buybacks. Musk knows this because he watched Boeing burn tens of billions on Starliner delays while repurchasing $43 billion of its own shares. Public market incentives turned America's premier engineering giant into a financial engineering machine. SpaceX was explicitly created to prevent that exact outcome. By maintaining absolute private control, Elon Musk shields the engineering culture from Wall Street short-termism. He can fail, explode hardware, and burn billions without asking permission from pension funds or regulatory commissions. This private ownership shield is the single reason SpaceX conquered modern spaceflight, and it is why an IPO remains the single largest existential threat to the company's ultimate mission. When you look at that April 20 explosion in Boca Chica, you aren't seeing a failure. You are looking at the freedom of private capital working exactly as intended. Wall Street doesn't fund science fiction. It funds quarterly returns, and the day SpaceX goes public is the day the dream of Mars officially dies. SpaceX is not the only company hiding massive financial structural secret from retail investors. Another tech founder copied this exact corporate governance playbook, written 20 years earlier by a titan who never got caught. If you want the full story behind how these financial empires are built before they break, subscribe to Built and Broken right now.